Today we have Jahn Karsybaev on our podcast. He's the co-founder and managing partner at Big Sky Capital. Their first fund was a $20 million early stage VC fund investing in enterprise SaaS. And now they are on to fund two, which is a $50 million fund. But your operator to investor transition, right? I want to understand a little bit about that. How does a operator experience shape up the investment thesis and how you invest?
Yeah, that's a great question, Amit. And we've been asking ourselves that for quite some time. Throughout the journey, when I was a founder of a startup right out of college as well, I don't come from money. I don't come from, wealthy family or anything as such. So access to capital has always been a challenge. Also, throughout the fundraising journey, working with investors, various size or various levels, VCs, individual investors, it's been a mixed experience, mixed journey. So I've been taking a lot of mental notes myself throughout just these meetings with different, investors, that there's certain things that I would probably do different if I was on their shoes. We have multiple, in-house startups of our own. And I completely understand and respect the fact how difficult that is to build your own startup. And it's one of the first questions that I actually ask when I meet the founders for the very first time is, do you actually have very good understanding of how difficult that is to build a startup, how much pain that is? And, Musk says that for a reason, right? That building a startup is like chewing glass and staring into abyss on a daily basis.
You have actually worked in some of these big enterprises and you would have seen your portfolio companies selling to enterprises. I wanted to ask you a very specific question. Usually startups think about distribution, especially B2B companies, in sort of two very different approaches. Like one of them is you go to small and medium businesses first. Easier to crack a deal with them. They have smaller compliance and regulatory departments and lesser friction overall. And you get a bunch of logos and then you go to bigger companies. Approach number two is like what Harvey AI did. They went to the top 100 law firms in the States and then started there, right? Which is like completely playing the big game from day zero. Like, YC actually advocates approach one, and there are a lot of VCs who actually sort of advocate approach two. What is that you suggest to your companies, and in general, what is your thoughts on this?
It's relatively easier, especially these days, to build technology, to launch it because of the tools that we have available to us. But to sell that and to get that to the right user and identify your ICP, your ideal client persona, and really try to narrow down, go 5 levels below, that's, a combination of art and a science, and it's very, very difficult.
I can resonate it with so much because as GI Ventures, we actually partner with top domain experts in niches within financial services, commerce, and other areas, and then build companies with them. Pretty much these people have 10, 15, 18 years experience in their particular domain, and they wanted to solve a problem for a very long time. So that brings in a lot of understanding of the industry structure, data. There's a network they have. They're able to sell to the enterprises. Jan, it will be also interesting to know your overall thesis on AI and any specific company examples that you have invested in and any areas that you are looking forward to investing in.
Build AI, push the limit, conversations with no gimmick, tech and juice collide in sync, that you're on, don't stop to think.
Hello, everyone, and welcome to yet another episode of Build AI. Today, we have Jahn Karsybaev on our podcast. He's the co-founder and managing partner at Big Sky Capital. Their first fund was a $20 million early stage VC fund investing in enterprise SaaS, in other areas. And now they are on to fund two, which is a $50 million fund. Welcome, Jan.
Thanks so much, Amit. Really a pleasure to join you on your podcast.
Absolutely. I'm sure this is going to be fun. So maybe we can start from the beginning. You have roots in Kazakhstan, right? So I wanted to first start there, right? What was your journey from Kazakhstan and then Montana and then Fortune 500 tech executive and then a VC firm, right? So can you walk us through it?
Yeah, sure thing. I'll try to keep it brief. So originally, I was born in Kazakhstan. I'm actually currently in Kazakhstan myself as well. It's probably the largest country that you've never heard of, but it's located in Central Asia. It's largest country in the world, former Soviet Union republic. So I finished high school in Kazakhstan, then I moved to US afterwards to attend undergrad at the University of Montana. That's where I met my fund partner. He's also from Kazakhstan, and hence the name of the fund is Big Sky Capital, because every state has its own slogan. So Montana is a big sky country. So that's where actually that originates. So after undergrad, I spent some time in corporate sector, mostly in technology, working in various roles from product project to C-level. And throughout the journey also, there were multiple entrepreneurial stints where I had my own startups. Me and my fund partner, Adil, we also had a couple of startups together. Several successful failures, a couple of exits, and we've also, been angel investing on the side ourselves for quite some time, built a portfolio. And pre-pandemic, we've had a conversation that probably was the right time to start and go to the dark side, as we call that, and raise our fund. And a little after the pandemic, around the 2021, 2022, we started the fundraise. Took us a little bit over a year to raise the first fund. And we've so far deployed into 30 companies. We focus on 3 regions. Southeast Asia, my partner is based out of Malaysia. We invest in Malaysia, Singapore, Central Asia as well, because we do have an office here in Kazakhstan, but we invest in all of the Central Asia right now. Quite a few companies, maybe a third of portfolio is out of Kazakhstan and Uzbekistan as well, and US as well. I'm personally was based out of Fort Lauderdale and currently spending time in Kazakhstan. So that's a little bit of a brief.
A very dear friend from college who was my roommate from Fort Lauderdale. So I keep going there every now and then. So two things, maybe one after the other. So first thing, I myself basically was a founder 2 times and sold my last company to a New York based unicorn. Now I'm sort of quasi investing. We are a venture builder and a fund. So we do both. We are both on the bright side and the dark side, using the analogy. But your operator to investor transition, right? I want to understand a little bit about that. How does, like, it will be great for the audience because some of them may be going through the transition or may go through the transition later on. How does a operator experience shape up the investment thesis and how you invest? How does it help?
Yeah, that's a great question, Amit. And we've been asking ourselves that for quite some time, even when we, pre-VC, pre-investing world for us, even for myself, I've been fundraising all the time, for my own startups, for the fund as well. And throughout the journey, when I was a founder of a startup, right out of college as well, I don't come from money. I don't come from, wealthy family or anything as such. So access to capital has always been a challenge. And also throughout the fundraising journey, working with investors, various size or various levels, VCs, individual investors, it's been a mixed experience, mixed journey. So I've been taking a lot of, mental notes myself throughout just these meetings with different, investors, that there's certain things that I would probably do different if I was on their shoes, if I was the investor. And it always also resonated on various levels when I was meeting with either an operator or former entrepreneur myself versus somebody who is out of, top level Ivy League business school, who graduated and went straight into investing from that without having any, hands-on practical experience of what it takes to build a company. I've had that, I still have that. We have multiple, in-house startups of our own. And I completely understand and respect the fact how difficult that is to build your own startup. And it's one of the first questions that I actually ask when I meet the founders for the very first time is, do you actually have a very good understanding of how difficult that is to build a startup, how much pain that is? And, Musk says that for a reason, right? That building a startup is like chewing glass and staring into abyss on a daily basis, which is very true. And if the founder has that understanding or at least that level of experience, how difficult that is, that actually moves the needle in the conversation. So being a former operator, entrepreneur myself, it's a huge advantage. It's a huge, unfair advantage that I think that we have as VCs to be able to find those points of synergy with the founders that we meet with for the very first time.
Right. Well said. I think it will also be interesting for the audience to know a little bit about the kind of investments you have made. And since there are 30 of them, I'm not sure if we can go through all of them, but at least if you can tell us, like, what are the major segments with a special focus on what have you invested in the AI space, especially as we know it today, right? The last 2-3 years of AI.
Yeah, absolutely. So as a fund, the investment thesis is enterprise AI or B2B SaaS. We don't touch crypto. We don't touch D2C companies and marketplaces for reasons that I'll explain. And right now, we're also sector agnostic. We're a generalist fund because we want to make sure that we mitigate the risk by exposing ourselves to various opportunities. And right now, as I mentioned, the portfolio consists of more or less evenly split. A third of the portfolio is out of Southeast Asia, third is out of Central Asia, and third is out of US. And I would say, predominant sectors that we see in the portfolio are cybersecurity, fitness tech, fintech. We have a couple of agro-tech companies. So those, health tech as well. We have several startups that are doing really, really well in that space. So we look at, different verticals that obviously the market size has to be significant enough to be able to justify the risk. But also, what are the areas that incremental improvements such as AI can make a huge impact. For example, healthcare especially in US is very archaic and very, behind, I would say, just overall in technology, not even AI. And if you build a solution that definitely solves a particular pain and you have a good understanding and craft a GTM that you're able to get access to the decision makers in terms of the business development, I see that it's an interesting opportunity in terms of the founders that we decide to work with. So, second fund, it's probably we will follow more or less the same thesis, just the check size is going to be larger. And we're going to focus on the companies in the same verticals, in the same stage, but no, not the stage, but we'll focus more on like later stage companies like Series A. So it's actually a lot of companies that, in the corporate sector, being a C-level tech executive myself, I still stay very close in touch with, executives at companies of various size from my network. And we discuss different pain points and the areas that they wish actually some of the startups would be solving. And right now with, rapid growth of AI, developer productivity is also one of the at the top of mind for a lot of these executives. So the other challenge is obviously integrating or implementing such solutions in the corporate sector and enterprise. It's very, very challenging. And a lot of founders don't have that clear understanding or strategy, even post sales. How do you go about that actual implementation, that integration? That's, it's a beast of its own. And one of the reasons we decided to invest in B2B is because we saw that the type of founder was building enterprise solution. It's someone who is very experienced. It's someone who is not right out of college and building a marketplace. It's someone who had spent couple of years, several years in enterprise and corporate themselves. They've encountered a problem and they have been able to successfully build a team around them and recruit them and motivate them to join them on this journey to build that type of solution. So it's one of the reasons why we decided to choose that enterprise AI, B2B SaaS is the area, the type of founders that we can definitely be of value.
Right. I can resonate it with so much because at GI Ventures, we actually partner with top domain experts in niches within financial services, commerce, and other areas, and then build companies with them. Pretty much these people have 10, 15, 18 years experience in their particular domain, and they wanted to solve a problem for a very long time. So that brings in a lot of understanding of the industry structure, data. There's a network they have. They're able to sell to the enterprises. So I completely sort of resonate with what you're saying. Jan, it will be also interesting to know your overall thesis on AI and any specific company examples that you have invested in and any areas that you are looking forward to investing in within AI.
Yeah, that's definitely a very loaded question that we could probably spend the rest of the podcast talking about this, but I'll try to narrow it down so I can give you a couple of examples where we see a huge opportunity there. So one area that really stands out is, longevity and fitness. It's an area of personal passion of mine. And, I, come from a very athletic family. Both of my parents are, professional coaches. And I've been in fitness all my life myself. I ran kind of D2 track as well in college. And, to this day, I still, on daily basis, fitness is a huge part of my life. So I'm very passionate about that space. And I also see how much impact AI makes in longevity, in wellness, in fitness in general. So there's a couple of companies that we've backed and invested into. I could probably understand that there's a lot of hype around that as well. And there's a lot of studies, a lot of research that's been published that AI in general is yet to make a significant impact in, various domains, especially in this one included, where we are yet to see significant results where, a particular AI solution has been able to deliver. something from that standpoint. So it's really trying to understand the, going back to the what exactly the type of pain that the company is trying to solve. And it's the pain that, if I deal with that on a daily basis, myself and my family, my children, that moves the needle in terms of decision making, because I know that for a fact is something that I will use. So it's one of those initial kind of gut check reaction criteria that I try to subscribe to when I meet the founders for the very first time. So a couple of fitness tech companies like Hero's Journey, they're building through AI. They focusing on the area of retention, because in fitness and anything that from that standpoint, retention is the biggest problem. Us as human beings, we're creatures of habit as well, and it's so difficult to develop any type of habits. So anytime you could pair up a technology with something scientifically backed to be able to help people develop more healthier habits, I see that as a huge opportunity. And it's something that AI not necessarily will be able to replace, but power up. So those companies are very interesting to me, on a personal level, and I'll continue investing in fitness tech and longevity space and anything that has to do with kind of just overall well-being. Cybersecurity is also a couple of companies we have in the portfolio that we see AI making significant impact in terms of at least streamline and automating the rudimentary basic tasks of cybersec. And as we all experience these days, that the next war is probably going to be already being fought in digital space. So companies that are able to help companies identify, such as Key Caliber that we have in the portfolio, that are able to identify at least those signals in terms of, hey, these are the areas of maybe potential weakness in your entire ecosystem of your corporation that you should pay attention to. That, it's not necessarily a solution of end to end, but it solves a problem and it helps the companies mitigate certain risks. So those are just some of the quick examples that we see AI making significant impact from that standpoint. But then also, the bigger challenge becomes, as I mentioned earlier, is the ability to integrate and ability to implement something into the existing ecosystem of a large corporation.
Right. That's very interesting, actually. And given that you have actually worked in some of these big enterprises and you would have seen your portfolio companies selling to enterprises, I wanted to ask you a very specific question since you have been an operator as well. Usually, startups think about distribution, especially B2B companies, in sort of two very different approaches. Like one of them is you go to small and medium businesses first, easier to crack a deal with them. They have smaller compliance and regulatory departments and lesser friction overall, and you get a bunch of logos and then you go to bigger companies. That's approach number one. Approach number two is like what Harvey AI did. They went to the top 100 law firms in the States and then started there, right? Which is like completely like playing the big game from day zero. Now they're different, like YC actually advocates approach one, and there are a lot of VCs who actually sort of advocate approach two. What is that you suggest to your companies, and in general, what is your thoughts on this?
Yeah, that's it's an ongoing dilemma and it's an ongoing challenge for every startup, especially that's trying to sell at enterprise, because that's the, as harsh as it may sound, anyone can build a product, anyone can build a technology. Well, I don't mean anyone, but it's relatively easier, especially these days, to build technology, to launch it because of the tools that we have available to us. But to sell that and to get that to the right user and identify your ICP, your ideal client persona, and really try to narrow down, go 5 levels below, that's, a combination of art and the science, and it's very, very difficult. And we spend a lot of time talking to founders on that particular area, their GTM, their business development process, and how do you replicate that so that it becomes scalable at 100x. So it's, there's no right or wrong, but in, business development, especially in enterprise, a lot of that, it all starts with, it's a relationship game, just like with anything. And top-down approach in enterprise, it definitely works, because for you to be able to identify strategy, how will I get to the right decision maker at the right company? That's, it's a challenge of its own, and how do you execute on that? So I spend a lot of time talking to founders and, pre-investment on their thoughts, on their strategy, on how, when your personal Rolodex runs out and you stop, your friends your friends and networks, stop returning your calls. What is your strategy to be able to, on ongoing basis, to generate that flywheel, to be able to get to the right decision makers on consistent and ongoing basis? And then also, how do you maintain that relationship? Because in enterprise and B2B sales, one of the most important metrics, especially for VCs and us, is the NRR, the net revenue retention, is how much money basically you generate from your existing clients. That's a huge factor because you can bring somebody in-house. You can probably generate the initial sale, but the amount of money you generate from them on an ongoing basis and how much of that is actually returns, it's a huge indicator in terms of your ability to build a product that actually solves this particular solution. So, from the Y Combinator perspective or from whatever else, the strategy that may be, it's really, you got to be able to adjust to the type of client that you're serving and maintain that relationship and come up with creative ways, creative strategies to get access to that and continue have that open dialogue with them. So that, again, like when your personal connections run out, like how are you going to go about, those sales? And then is that model replicatable? Are you able to scale that at X? Harvey, I'm sure they've spent many, many years before they found that flywheel to be able to get in the door of the top law firms in US because, especially working with lawyers, it's a relationship game. So I'm sure there was a lot of homework and a lot of prep work that was executed to be able to now show the results that are being demonstrated. So those are just kind of very high level thoughts into the enterprise sales.
No, that's very helpful. It's also something that evolves, as you said, right? It's not cast in stone. Every company has to figure out their own distribution channel. Usually, we have seen that the most successful companies nailed at least one distribution channel of their own. But then I'm switching gears towards what type of founders, right? In our business, it is very important to, the founder and the team is everything, right? As they say. I read somewhere about you and your fund that you have a special focus on, or at least some part of the focus on immigrant and underrepresented founders. I wanted to know a little bit about that, but also what kind of founders and what kind of signals matter most to you?
Yeah, that's a great question. And the answer to that is also, it's evolves all the time because as we build that muscle and, build that kind of also our own internal criteria as we meet with the founders on daily basis, and we try to continuously improve that process or at least that thought process, mental models to be able to identify those signals on an ongoing basis because the biggest challenge for VCs is to also rely on that intuition and that kind of that gut feeling. Because if your intuition tells you one thing, but you follow your internal checklist, and it's a balance that you have to manage as a risk manager first, and then as a capital allocator second. So the diverse, underrepresented immigrant founders, yes, that's a very huge and important aspect of our investment thesis. Mainly because at the end of the day, that's who I am. That's who we are as a team. We all, especially in US, we immigrants ourselves, and we understand the challenges, we understand the difficulty of that, and we also understand how that could be an advantage when it comes to competition as well. So those, for various reasons from a personal experience in the past, that's important for me to be able to work with the founders that come from scarcity and come from, emerging markets that don't necessarily have access to capital, for example, and how do they come up with creative ways, creative solutions, so that if you're knocking on the door and nobody's opening the door, how are you going to climb through the roof or how are you going to climb through the window to be able to find, to get to what you're trying to do. And also the other criteria is also kind of that relentlessness, not taking the no for an answer, and also not getting discouraged because at the end of the day, as we spoke initially, building a startup is also very lonely. And even if you have co-founder, being at the top of the food chain, being the CEO of your company, it's a very, very lonely job. And how do you go about maintaining that day in and day out, that drive, that energy, that motivation to be able to have that very thick skin and take rejection on daily basis and turn that rejection actually into an opportunity? That's very huge, that's very unique, and it's very rare to find. because we're all human beings, and it's very difficult to deal with rejection, especially when you're fundraising, especially when you're growing the company. And that's a daily grind. And how are you able to personally maintain that and not get that break you? Those things are very important, and try to pick up on some of those indicators. How does a founder able to kind of bring them back and turn that, not necessarily view daily encounters as problems, but view them as opportunity to improve, opportunity to change your pitch, or opportunity to change your approach, or something from that extent. That's a huge indicator. It's a big signal in terms of the type of founder that we want to associate ourselves with. Because when I invest, it's to invest, give somebody a check and watch from the sidelines. That's not interesting. It's not fun, and it's not something that I want to do, because I'm at a stage of my career that if I'm not having fun with you, and it's not a space where I'm really enjoying myself personally, probably doesn't even make sense to get involved. Because VC, it's a very long game, and it's getting, actually even longer. So for me to be able to build that relationship with the founder early stage and identify areas that this is something definitely we could spend a lot of years working together on. Those are usually good signals to say, yeah, maybe let's explore something further. So those are some of the indicators. And also, if a conversation starts with bad news, usually that's a good indication that relationship is there, because as human beings, we have that internal radar to pick up on bullshit and to see that, as they say, horses smell fear, from very far away. And the same, with human beings as well, that if something is being hidden, something is being not transparently communicated, usually some type of tinkle, some type of senses inside of you that will tell you. But if you're being very honest and very transparent from the very beginning, I think it's something to be explored further.
Talking about bad news and good news, I want to ask you, like, what traction or milestones at the fund, at Blue Sky Capital, or at the portfolio level you are most proud of so far? Like, what have been the achievements so far?
It's tough to answer, because we're a very new fund in VC metrics, and we've been in existence for a little over 2 years. Considering how risky this game is, I can with full confidence say that out of the entire 30 companies we've invested in, not a single company has died. So that's a metric for us. And quite a few of those that are actually growing at a tremendous pace on a year-over-year basis. And it's hard to identify any type of specific metrics that really identify that this is definitely a winner. But it's something, again, just going back to a very transparent communication. The other factor that's important for me as an investor is to be able to have some type of influence at the board level. We actually wrote a book, me and my fund partner. It's called VC Boards: How to be an effective board director of VC or PE-backed company, because there's a lot of misconception in terms of what a board is and what it's for. For a lot of founders not having that experience, it's typically board is associated with some type of loss of control, or a bunch of people sitting around the table telling me what to do. In reality, if you have that experience and you're able to design an effective board for your company, that becomes a secret weapon. It becomes a huge advantage if you're able to leverage that expertise, if you're able to leverage those types of executives on your board that are able to open the doors that may be challenging for you to get access to yourself, or they can help you with the fundraise, or they can help you on the technology side. That's a huge advantage. So a lot of times pre-investing, we spend a lot of time looking at, does the board even exist at that startup? How do they leverage the board directors? What do they have the board for? I'm not a believer that if I write the largest check, I should automatically be on your board. That to me doesn't make a lot of sense. It should, in the first place, boil down to, what type of value can I bring to this company? And can I be actually of an effective board director and help the company grow? Those are some of the metrics. So those are just kind of some of the thoughts around, how do we go about, just overall thinking from an investment standpoint.
That's very interesting. I'm going to check out the book that you have written. I keep joining the boards every now and then. So I think it will be very helpful for me as well. And also people who have been operators and investors, this is my personal thing. I always feel like they write really well and they write good books a lot of times. My partner, Vijay, he worked at 500 Global, the VC firm, and then at BBVA Ventures. And he wrote a book last year called The Funding Framework. And I think it's a very good distilled view of how, founders should approach it. And so I'm also going to sort of go through your book and sort of learn about what to do when you're on the board.
I appreciate
Now, you said that you started the fund 2 years back. So I'm guessing, let's say somewhere you started probably planning for it and started talking to some potential investors maybe a year before that. So let's say 23 is when the
22.
groundwork started.
22. Yeah.
2020. So that brings me to my favorite question that 21 and 22 were the finest years in, I mean, depends on how you look at it, they were the worst or the finest years in venture. Checks were being written based on like one email and one deck. And it was also incredibly easy to raise a fund from LPs. Individuals were writing like 500K checks at the time. Versus now, today, it's incredibly difficult. Like, I have not seen last time any individual writing like a 500K check anymore. So, can you talk about, like, because there are a few fund managers that listen to this podcast, I think it will be interesting, including for us as well. Like, what are you seeing? And is it now that strategy has completely changed and you go to family offices and institutional LPs, or still there is a lot of juice in that individual HNI segment?
That's another great question, Amit, and you're absolutely right. Fortunately or unfortunately, we missed that period of post-pandemic where capital was relatively easier available than it is right now. Which probably also in the hindsight, it's better that we missed that period because it really forced us to think that fundraising is a strategy, fundraising is a challenge, fundraising is an opportunity, and it's something that you have to approach very carefully from the very beginning. Requires quite a bit of planning, as you mentioned, way in advance, because especially for emerging managers like ours, we don't necessarily have a lot to show from standpoint of our portfolio. And it's very same framework here that LPs, the investors who invested into our fund, first and foremost, they invested into us. And they believed in us as the risk managers, as the operators of the fund, that we are the type of people that they want to bet on, that we are the type of people that would take this type of business very seriously, that, especially anytime you become responsible for someone else's money, that adds another layer of complexity and responsibility from that perspective of managing and 10xing their hard-earned money. So it's a responsibility of its own. And at the end of the day, it's also having realistic expectations that in any type of fundraising environment, you should never expect an immediate answer. It's just simply unfair to both sides to be able to go into a presentation and expect an immediate check being written or some type of response. And I don't necessarily believe in that, because sometimes when founders come in and they ask point blank, are you interested to invest, yes or no? It's not something that the type of dialogue that I want to continue with, because it just proves to me that there is no quiet interest or interest in investing into the relationship, because every LP, everyone who backed us on both sides, it's at the end of the day, it's a very long-term relationship game. We're very transparent from the very beginning of how risky that business is. It's probably one of the riskiest in terms of the mortality rate of the companies that do shut down. But at the same time, the upside is also unlimited. That the reason it's also called Big Sky is the sky's the limit from a standpoint of where the company could go if you make the right bet. So just like with every founder who is fundraising for their startup, it's exactly the same game for the fund managers as they approach this entire life cycle of the fundraise. Is that you first and foremost invest into a relationship and you build that relationship on ongoing basis. It doesn't stop with just one pitch presentation where you show a beautiful deck and then after the deck you open up the data room and then you expect an answer from there. Doesn't quite work that way. So there's some LPs that we've known for 20, 30 years, and there's some LPs that institutional investors that we've been talking to for about 2 years, keeping them consistently updated and sharing with them the insights, and just basically being very transparent, not only with our wins but also with our losses in terms of the areas where we could do better moving forward. So those are just some of the thoughts that I prescribe to, and I'm gonna continuously prescribe to as I fundraise for my second, my third, and so forth funds.
No, this is great. We covered a lot of topics. I actually missed asking you one question. Maybe that's the last question I'll ask you. We are almost there on time, like a couple of minutes left. I forgot to ask you that as you are probably looking at a pipeline of AI enterprise SaaS companies or vertical AI companies, in sort of your own mental framework, how do you what do you think is kind of more important or less important, right? That things like some people give a lot of weight to data and data modes, and then, like for example, we focus a lot on workflow and how deeply do you understand a workflow, and how important is that workflow in that particular sector and in that particular industry. And then there are like VCs who focus a lot on distribution. Like, I don't care like how good the product is, what is the workflow, data mode, as long as you can sell. Now, of course, all of this is important. We all look at everything, but usually there is something which is like slightly more important than the other.
Yeah, those are important aspects that you bring up, Amit, especially when it comes to AI, because we've seen that change probably by the hour these days and not even on daily basis. So when it comes to a specific area, whether that's the actual technology, that's behind the AI that's being built, or is that a distribution channels, or is that an actual workflow, or just the overall data oversight and infrastructure, how do you go about that? And you said it yourself, it's impossible to identify one specific aspect of that. It's just being able to, very effectively balance all of those all of those balls that you're trying to juggle when it comes to building out the right technology, but also knowing when to stop, because that's the biggest challenge. Even for myself, when I build technology, it's at what point that you need to draw the line in the sand and say, this product is good enough for me to be able to go sell that. That's why frameworks such as, Slick versus the MVP, we love that a little bit more, because Slick, simple, lovable, complete, that's a little bit of a better analogy than the minimal viable product, because it's something that you understand the space, you understand the workflow, you understand the technology, and you're able to say, this is the type of problem I'm solving, and I can bring the version of my product to my ICP and try to match to see that it's something that they're going to use. So it requires very thorough planning. It requires relentless execution, but also in those very early stages when you're trying to find that flywheel, it's a lot of experimentation. So as founders and co-founders of AI startup, it's very important to have that understanding that if today's version of a product is one, and the demands or the pains of my client are changing, I need to be able to adapt to that, and I need to be able to adapt to that very quickly. So a lot of times some founders are not capable of making that adjustment, and it kills them, because you pour your heart and soul and everything into your product, and it's not being utilized, it's not being put in front of the right audience. That can crush you. So finding that right balance is always the key.
Right. Thank you so much, and it was great talking to you. And this was really, really helpful. I'm sure the audience got a lot from it. Thanks for your time.
Likewise, Amit, I really appreciate the invitation, and looking forward to staying in touch with you.
Absolutely.